Okay, let's jump right into this explainer. If you just glance at the headlines, the stock market looks practically invincible right now. It's like we're in some golden age of returns. But when we actually dig into the cross-asset data from today's market brief, wow, we uncover this fascinating, tightly coiled spring of hidden tensions just waiting to snap. To help us navigate this massive ocean of data, we're breaking things down into 5 quick chapters. First, the calm before CPI. Second, the oil and inflation shock. 3, the AI reality check. 4, fear, greed, and gold. And finally, number 5, what breaks the market. Let's get right to it.
So, Chapter 1, the calm before CPI. We're kicking things off by looking at this incredible paradox that is frankly blinding a lot of investors out there right now.
Get this, the S&P 500 is coiled just 0.6%, literally a hair's breadth underneath its all-time record high of 7,793.68. If you're just looking at this one index, it paints a picture of absolute, perfect tranquility. We are sitting right at the absolute peak of the mountain, right? The air is thin, the view is spectacular, everything seems totally stable. But, as anyone who climbs will tell you, the very top of the mountain is usually the most dangerous place to stand, especially when you can't see the storm brewing just over the ridge.
And this number right here perfectly captures that widespread complacency. The VIX, the market's fear gauge, is sitting at a highly compressed 1546. It's actually down over the last month. That marks its lowest realized volatility of this whole run. Honestly, investors are practically asleep at the wheel here. They're pricing in a completely smooth ride ahead, with almost zero expectation for any sudden bumps or sharp turns.
But let's look under the hood for a second. The engine's usual cylinders, mega-cap tech, they're sputtering. Over the last 30 days, the Nasdaq 100 has actually been the absolute laggard of the major U.S. indices, up just a measly 0.96%. Meanwhile, these unexpected, greedy cylinders are firing up to keep the whole car moving. Blue-collar cyclicals and energy, they are leading the charge. The S&P Midcap 400 is up 3% and the Dow is up 2.67%. So the market is hitting these highs without its historical Magnificent 7 engine. Heavyweights like Nvidia and Intel have been under some serious downward pressure, which is completely masking this massive quiet rotation happening right beneath the surface.
Moving on to Chapter 2, the oil and inflation shock. Let's see exactly how this eerie calm feeds into a much larger, hidden macroeconomic risk.
Right now, oil is the true macro driver. WTI crude has surged almost 7% this month alone, and it is up a staggering 32.1% on the year. Now, this isn't some massive economic boom driving up demand. No, this move is pure supply risk. We're seeing immense geopolitical pressures stacking up globally. We've got strict new demands on Iran. The Strait of Hormuz is effectively shut to normal traffic, and we're seeing ongoing attacks on tankers and refineries in the region.
And to make things even more fragile, the U.S. Strategic Petroleum Reserve just dropped below 300 million barrels. That is the first time we've seen levels that low since 1983. Now, why should you care about that? Well, because the SPR is our usual policy circuit breaker. In the past, if oil spiked dangerously high, the government could just release some reserves, flood the market, and cool those prices right down. But today, that buffer is severely depleted. That means the global market is entirely exposed to the raw volatility of these geopolitical shocks, with basically no real safety net to catch the fall.
So here's the crucial point. This oil shock, it's forcing global borrowing costs up simultaneously. This is not just a U.S. story. Yes, the U.S. 10-year yield is near a 7-month high at 4.724%, but look globally. The U.K. is over 5%, Australia is over 5%, and even Japan is climbing near 2.8%, with the Bank of Japan actively showing a tightening bias. The term premium is literally being rebuilt everywhere at once. And in plain English, term premium just means investors are saying, hey, with all this geopolitical uncertainty, you need to pay me more to hold long-term debt. The market is pricing in persistent, sticky inflation driven by oil, pushing yields higher everywhere, even when local labor data looks a bit soft.
Which brings us to Chapter 3, the AI reality check. This global spike in yields we were just talking about, it's creating a massive reality check for the AI and infrastructure sectors. Take Rocket Lab as the ultimate template for how this new reality is trading. I mean, they just posted an absolutely stellar quarter. We're talking record revenue up 62% year over year, a record backlog of over $2.3 billion, more than $1 billion in new contracts signed just for Q3 alone, plus a major new agreement to acquire Iridium. By basically any traditional growth metric, this is a phenomenal beat. Investors should have been cheering in the streets, right? Well, check this out.
Despite those massive, undisputed wins, the stock plummeted nearly 7% after hours. It closed down during the normal trading day and then completely fell off a cliff in extended trading. It's a totally counterintuitive reaction if you're only looking at the top-line numbers.
So, why on earth did that happen? Welcome to the cash burn penalty. The AI and infrastructure demand thesis is completely intact. I mean, these companies are absolutely getting the massive orders. But the equity thesis? That's cracking, because the cost of capital is just too high right now. Investors are abruptly demanding free cash flow today rather than grand promises of revenue tomorrow. The market has completely stopped paying a premium for a giant backlog. Instead, they've started actively punishing companies for the highly levered balance sheets and massive cash burn that's required to actually fulfill those contracts.
All right, Chapter 4, Fear, Greed, and Gold. All of this underlying tension we've covered between sky-high stock indices and rising global borrowing costs. It's creating these violent emotional splits across different asset classes.
Just look at this incredible divergence. While traditional equity investors are resting comfortably in a state of greed, sitting at 64 on the index, crypto investors are mired deep in fear at 30. And historically, crypto is a highly sensitive leading indicator for risk appetite. The fact that Bitcoin is struggling to hold ground and overall crypto sentiment is stuck in the fear zone, all while the S&P 500 is just floating near record highs, that is a genuine divergence. It tells us very clearly, do not treat these equity highs as some broad green light risk-on signal. The foundations here are highly fractured. Meanwhile, the classic safe haven is practically screaming that something is wrong. Gold is up over 30% on the year, recently hitting a 2-month high above $4,400. And you really need to know, this isn't just retail speculation or everyday day traders pushing the price up. The bid underneath gold right now is structural. It's official. Global central banks are aggressively buying, led by China's central bank, the PBOC, which added roughly 20 tons in July alone. Chinese gold ETFs are also seeing their longest streak of continuous inflows in months. Basically, smart, massive pools of institutional money are actively seeking safety from the exact volatility that equity markets are currently ignoring.
Which leads us to our final section, Chapter 5, What Breaks the Market. All of these tectonic plates, the compressed volatility, the rotating stock market, surging oil, rising global yields, and that massive safe haven buying, they're all shifting right beneath our feet as we approach a real make-or-break climax.
Analysts have mapped out 3 distinct catalysts that could instantly ignite this powder keg and just flip the market on its head. First, an inflation spike. If the upcoming Wednesday CPI print comes in hot because of that surging oil price, the odds of a September Fed rate hike are going to spike. That drives the 10-year yield straight through 4.75% and triggers a major stock market drop. Second, the geopolitical wildcard. Imagine a surprise peace deal or sudden resolution in the Strait of Hormuz. In an instant, oil could gap down $5 or more, energy leadership would die off, and the lagging Nasdaq would likely rip violently higher. Finally, a debt rejection. We've got a massive $39 billion 10-year Treasury auction approaching. If buyers balk at these rising yields, a failed auction could cause a severe spike in global term premiums. Honestly, that would do more immediate, lasting damage to equities than almost any other single data point.
But the most immediate hurdle is right in front of us. Everything hinges on Wednesday's Consumer Price Index report. Think about the precarious setup we've just mapped out. The S&P 500 is essentially sitting at a record high. The risk-free rate you can get in bonds is a very competitive 4.72%, and the primary driver of inflation, oil, is up 7% in just a few weeks. Because of this exact tightly coiled setup, there is absolutely zero margin for error going into this inflation data. If the numbers don't perfectly align with the market's optimistic greed narrative, the repricing could be incredibly violent. So as you process all these hidden risks, the fading tech engines, the geopolitical oil shock, the AI cash burn penalty we talked about, I want you to consider this final thought on the ultimate safe haven. Gold is up 30% this year, yet it's still 22% below its January all-time highs. Is this current rally just the foundation? Is it a multi-quarter base being built by central banks preparing for a chaotic decade? Or have we already seen the absolute blow-off peak and the market is just slowly digesting the leftovers? The answer to that question will likely dictate how you navigate the turbulence that is undoubtedly coming our way. Thanks for joining me on this explainer, and definitely keep your eyes closely on that CPI data.